After several weeks of waiting under significant pressure from members of his own party to pull out of the election, President Joe Biden finally did so yesterday. And we're going to talk about the implications of his endorsement of Kamala Harris as his potential replacement and what that could do to the Trump trade today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So as all of you will certainly know, Joe Biden has withdrawn as the Democrats' candidate for the President of the United States. He's no longer seeking re-election, and he has endorsed his Vice President Kamala Harris. This isn't a particularly big surprise that he would do so. There's a couple reasons. First of all, it would be very strange if he did not endorse her to replace him. Secondly, my understanding of campaign finance rules is that she is eligible to use the considerable war chest of campaign funds that they have available where nobody else would be. Those funds, my understanding is, at least would have to be deployed via some super PAC, and that has some disadvantages as far as they're concerned. The other thing is that at this late hour, I think it is safe to say that the Democrats are going to need to coalesce around a candidate and basically try to pick up the pieces from basically the last couple of weeks since the debate. Now, since that debate, and we've talked about this a little bit, we had talked about potential hedges, broad market hedges going into the Democratic National Convention, first of all, and then secondly, the election in November. I think it's rather interesting to see, because we've talked about just the general strength of equities, but I think we need to be a little bit more specific, because one of the things that we have seen in the last couple of weeks is significant outperformance in two key areas. One is in small cap equities. So if you compare the performance of the Russell 2000 to the S&P, it had been lagging all year and it still lags, but notably between July 10th and the end of last week, the Russell 2000 outperformed the S&P 500 by nearly 9%. In fact, it may have actually exceeded 9% at one point. And we can take a look at that. We'll just take a quick comparison. I'll use the two primary ETFs for comparison here, but we'll just compare these. First, I'm going to put this in for IWM. I think that's probably easiest. So we're just going to compare very quickly the relative performance. I need to normalize this. So this is going back 1 year. This is going back year to date. And what you will see, and this is the part that I want to point out, is this lower portion of the chart. You can probably not see my cursor that well. What I'm going to do is I'm going to expand that. All right. So this is the underperformance. What you're looking at, what this chart is the relative performance of the Russell 2000 as measured by the IWM ETF versus the S&P 500 as measured by the SPY ETF. And what we can see is that as of July 11th, it was the Russell 2000, or I should more accurately say IWM, was underperforming SPY by almost 17% as of the 11th of July. Fast forward to the 17th, just 6 calendar days later, and what we see is that it had rebounded very sharply. In fact, actually looking at this, it would appear that the IWM outperformed SPY during that intervening period by 10%. It clawed back more than half of its underperformance year to date. And we can see that it fell a little bit last week. It has rebounded again slightly here. So a couple of things about this. Now, I actually want to bring up one other comparator as well. So I'm going to look at the relative value. So this is going to be the Russell 1000 value index. I'm just going to pull this up as well because we saw a very similar dynamic, not as pronounced, but a similar dynamic. We can see here that there was about 12% underperformance of the Russell 1000 Value Index versus SPY in this case. Significant outperformance in just a handful of trading days, gave a little of that back. We should discuss, I think, what is going on here. So I think that the relative performance of small cap stocks in particular is closely tracking at this point the chances of Trump winning the election in November. Why would that be? So the Russell 2000 is going to comprise, of course, smaller stocks. Now, the thing about smaller companies as opposed to the larger tech multinationals is that these are companies in particular that might be better poised to benefit from policies that are intended to benefit U.S. businesses rather than global businesses. And more specifically even than that, we could also suggest that, and there's another dynamic, it's not just the Trump thing, I'm going to get to that, that certain Trump policies that have been proposed, such as import tariffs in particular, would benefit these companies. So I think that's part of this equation. What's the other part? The other part is that as we begin to see economic data in terms of inflation data and in terms of employment data that would suggest there's a possibility that the Fed could reduce rates, that is going to impact the small cap stocks more profoundly than it will mega cap tech. These are companies that depend more on the debt markets. Their cost of capital will tend to be higher. And so I think these are the two principal drivers over the course of the last couple of weeks that have propelled this significant outperformance. So rates, the possibility of rate cuts, and I believe that smaller companies, US companies in particular, are probably better suited, better going to benefit from a Trump victory in November than the presumptive nominee at this point, Kamala Harris. So let's talk about this second part first, because my thinking is that what we saw today was that there was early a little bit of relative weakness in that trade, and then it rebounded. And I took that essentially to mean that markets are forecasting that Kamala Harris replacing Joe Biden does not meaningfully impact the likelihood of a Trump victory. I would like to offer the following two things. One, she is the presumptive nominee. I think it's unlikely at this point, especially with Whitmer's endorsement, with the Clintons' endorsement, and Pelosi's endorsement. And we believe that Pelosi and Schumer had a lot to do ultimately with Joe Biden's decision to withdraw. I think that we should at least acknowledge the possibility that Kamala Harris's popularity and her chances of victory, I believe they can't get much lower than they are right now. Her approval rating was as low or lower, depending on which poll you were looking at in the past couple of weeks, as low or lower than Joe Biden's. But we live in a very polarized time, and my expectation is that support for her is going to coalesce amongst the Democrats, and that overall what we're actually going to be contending with is not so much one party voting for their candidate, although I think there obviously are some, there's some core constituents, I think, that both Kamala Harris and Donald Trump possess. I think what we're actually also going to be seeing is that there are folks who absolutely are voting against the opponent. And I would have to think that over the course of the next couple of weeks, her chances of being elected in November can really only go higher. And if we believe that's true, because we're coming from a very low level, there is significant pricing going on in the markets for two things: a higher possibility of rate cuts and the possibility of a Trump election in November. To me, the smart play, therefore, is, and knowing that that situation can't get much worse than it is right now, one would have to reasonably hedge. If you are in what many are calling the Trump trade, so if you have elected to rotate into value, if you have rotated into small caps, based on that expectation, I believe that the intelligent thing to do now would actually be to hedge that aspect more tactically. And I don't think you need to do it all the way through the election necessarily. But I think that's the trade that has some vulnerability. Let's just really quickly just revert back for a moment to that spread that I was just talking about, because I think what it illustrates is just how volatile this relationship is. I mean, this is a pretty stunning amount of outperformance that we're seeing here. So I'm just going to take a look at that. So again, IWM was underperforming SPY by almost 17%. And then it outperformed SPY by 10% in 5 trading days. That's a pretty volatile relationship, I think we can all suggest. So what to do? I was looking, and I'm just going to pull up OptionPlay really quickly here. I was looking at, I should have had that booted up ahead of time. Forgive me for that. I was looking at a September 210-200 put spread in IWM. So folks will know when I have spoken about using put spreads in the past, debit put spreads in particular, at a minimum, I would like to see a payoff of 2-to-1, preferably 3-to-1. When I was looking at this earlier, the payoff on that trade was better than 3-to-1. So let's take a look at what it is right now. So now there's a couple ways you can play this. If you are playing it directly against a long position in small caps, you don't necessarily need to sort of look for the kind of gearing that you might get on something like this, but you can deploy that. So this particular trade is a little bit more about gearing than the SPY hedge that I had recommended before, because the idea there was buy some longer dated 30 delta puts, look for opportunities to spread it. This is a little bit different. First of all, the implied volatility in the Russell 2000, it is a more volatile index. That's understandable. There's more leverage there. Overall, it's more vulnerable. So when you take a look at those things, it tends to be slightly lower credit grade on balance. It shouldn't surprise us that the implied volatility is higher for the Russell 2000 because the volatility, the actual realized volatility of IWM, of the Russell 2000, is higher than the S&P. But this is the kind of relationship that I think one wants to look for. And as we can see, it's up a bit today, so this relationship is actually better than when I was looking at it earlier. So this is a $10 put spread, costs about $1.70. You know, I'm using mid-market prices here. You can ratchet that up a little bit. So if you're going to affect a trade like this, the only thing I would suggest is that you don't want to go too far out in time. I think we're probably going to get some visibility on what the outcome is going to be in terms of whether Kamala Harris's popularity is going to tick up or not in the ensuing, we'll call it 6 to 8 weeks. So this doesn't go out exactly 8 weeks, but we're getting pretty close, right? Going out to September 20th. So trying to get into, if you're going to put a $10 put spread on, you're looking for a $10 put spread where the net debit is going to be 2.5 or less. Here it is much less. You could actually get those strikes a little bit higher, I suppose. So this is really, you could use this, I guess, as an outright trade if one happened to think that over the course of the next couple of months we could suddenly see the chances that the Democrats retain the White House, retain the Senate potentially. I think gaining control of the House might be unlikely at this point, but those are the kinds of things that you would be playing for. So you could either use this as a speculative trade for that, or as a hedge against basically a reversion, basically on this more recent outperformance that we've seen in the Russell 2000. And again, there's two things that this is playing for. One, I believe it is going to improve. That is that these stocks are going to improve relative to the S&P, relative to mega cap tech stocks, in conjunction with the likelihood of Trump being elected. But I also think that this is very closely tied to rates. So those are the things that I would focus on. So with that, I think I'm going to move along, and we'll take a question here that I see on Amazon. August 180 calls, premium around $10 to $11. Analyst price targets keep going up. Do you see Amazon to 200 post QE next week? Okay, so a quick point I would make here about this. It's the value trade. This kind of goes back to this value trade idea as well. I do like Amazon. The reason I like Amazon is twofold. They're growing the top line significantly faster than nominal GDP growth or inflation. So that's a positive. The more important thing, though, is that this is a company that for a long time essentially was just reinvesting in its own growth continuously. And the narrative for the company always was that by throwing a couple levers, they could essentially move to profitability. And there were plenty of folks who sort of dismissed that because you do hear those narratives in other places. For example, another place that a narrative like that had sometimes been espoused was Netflix. And interestingly, both of these companies actually have done this recently. I don't know if you can see my screen right now. I have up here basically what's been going on over the course of the last couple of years. What we can see is twofold: good top line growth. More importantly, though, we're finally seeing some margins. So EBITDA margin, again, I prefer EBIT to EBITDA. This is just a default that Bloomberg chooses here. This is their adjusted numbers. We can dig into it more deeply on the income statement if we choose to do so. But the free cash flow numbers obviously are getting very good. Full year free cash flow estimates right now are for north of $61 billion. So this thing is a cash flow generating machine. That's the first thing. The margins are expanding. I don't see any reason why they don't seem to be losing out to other online participants on the retail side, and they are in a key and core business with real secular tailwinds with AWS and the cloud. And these things are all positives. Is it a cheap stock? I don't know if we can call it cheap necessarily. I don't know that cheap would be the way to characterize it, but it certainly does appear to be growth at a reasonable price. And so for those reasons, yeah, Amazon is one of the names I like. And this goes, by the way, I have to say, to one of the interesting things about the rotation we're seeing into value. Because a lot of people have been waiting for this. When are people going to start rotating into value stocks? I just want to, it may not be that easy to read, but I think it's important to take a look at what that would really mean. What lives in the value index? And when you start to take a look at the value index, this is when one begins to get a little bit more concerned about it. Value as a concept sounds appealing. It sounds, when people talk about value stocks, it sounds like you're getting a deal, like you are buying companies cheap or cheaply or cheaper, we should say. That's sort of the idea. It's sort of built into the name that you're getting a deal when you buy these companies. But then take a look at the companies that we're actually talking about and ask yourself, am I? I think just looking at this top page, I see a couple companies immediately that stick out to me that are problematic. Companies that seem problematic to me, just eyeballing this first page. By the way, this is 1,000 names on this list. And I actually was looking at this earlier, but top of the list here, Verizon Communications. Verizon Communications. Well, Verizon and AT&T, these companies are, I mean, not only are they not growing, but I think in real terms, they're probably shrinking. They have legacy, they have legacy issues associated with their wireline businesses. They're not particularly compelling businesses. They have massive amounts of debt on their balance sheet. Both can service their debt quite adequately at this point. But people own these stocks for their dividends. You're not owning them because they're going to grow even at the pace of the economy. That's problematic to me. Pfizer, right down here at the bottom. Similar situation. This is a company that one might have thought, because of their size, that they would be able to build a better pipeline. They just haven't done it. And that's a bit problematic. So as much as I think it's an appealing concept to see some rotation, and then you have really troubled companies right up here at the top, for example, Boeing. I mean, Boeing obviously had some gross missteps, deciding that they were going to try to squeeze another generation or two out of a more than half a century old single aisle airliner design to compete with Airbus's A320neo. They needed bigger engines on the 737s, and so that's how we got to the repositioned engines, which resulted in changed flight characteristics and the MCAS system and all the nonsense with the MAX. Some of these other things that have happened more recently, I'm not sure that it's really their fault. They just seem to have gotten into the news in a couple negative situations lately. Not all of them was Boeing actually to blame. But they really did lose, I think, that whole aura of being a true pilot's airline company. And that's problematic. It takes a long time. It takes a long time to build a good reputation. It takes a very short amount of time to unwind it, and it's going to take some time for them to rebuild it. And that's a problem. So when I look at these companies, there are companies on this list that I like, but there are many that I just can't get that enthusiastic about. Cisco, obviously, this was a tech era darling. Intel may be rounding the bend at long last, but it's a pretty hit or miss list, I think it would be safe to say, the value side. And so I can't really get behind the value trade at this point. I mean, if you think about what you're going to own and you're thinking 5 to 10 years out, are these the companies you really want to be in? I don't think so. I can see trading on the small cap side probably a little bit more than this. Okay, so there was another question. So I do like Amazon. Let's just take a quick peek here as well. So it's going to be August 1st that they're reporting. Options markets implying about a 7% move right now. And, oh, you know what? I want to just take a look. We're still above the 150, I'm pretty sure. That's kind of a critical level right there. So this is kind of what I'm interested in. Are we going to, violate this? But if you are, and actually, I'm sorry, I have to just double check. How far out in time were you looking for those calls? I'm going to just quickly head back here for one moment. August 180s. So, okay. Yeah, okay. A little on the short dated side for me. I don't usually like playing options with so little time, but we've identified a catalyst. That catalyst is earnings. It looks like options are reasonably priced. I like the name, so yeah, I think that's a reasonable. What you're paying 5-6% of the current stock price. Those are actually slightly in the money right now, so you don't actually need to see a move quite that big for those to pay off. But yeah, as a way to make a bullish bet on a name that I happen to like, then yes, I think that's fine. Okay, Steve B asks, can you talk about how you choose dates for your options? I've been trying to sell more near-dated options based on charts and buy more leaps. Okay, well, exactly the right strategy, I would say. If you're going to be short premium, I like 45 days and in. I typically don't like to be short premium going into events unless I really have, number one, a strong view and view the options premiums to be grossly overpriced for whatever reason. That's going to be case by case, to be sure, and to be longer dated options. One of the other reasons to be longer dated options is that it's not just a question of whether or not you're going to buy that long dated option and hold it all the way to expiration. That's not really what's going on. From one day to the next, a long dated option simply isn't going to decay that much. So if you're going to get into a poor man's covered call, something like that, you're going to get some positive carry, generally speaking, by owning long and being short. What are the things we want to think about, though? And that is, how steep is the term structure? And since we were looking at Amazon already, why don't we just use this as an example, since you didn't cite a specific one, but an earlier question did. So here we are. This is the term structure for Amazon options. And unsurprisingly, these options right here, which are the weeklies that capture earnings, have a much higher implied volatility than do the options that expire this week before earnings, and those thereafter. So what we saw is actually that these options are implying a move that's pretty much in line with what the company has historically offered. It has dipped pretty precipitously lately. Let's just take another look at a stock price chart here so we can put that into some context. So I would actually favor being short the options for this week and then waiting to see what happens, letting the price reset, and then going ahead and rolling again. So we can see that the stock obviously has fallen quite sharply here. It's down, almost 10%. From the prices that we saw earlier this month. So, yeah, I mean, these are the things you want to keep an eye on. One other quick point on the longer dated. You're going out to leaps, so you're always going to have multiple catalysts. You're going to have, if you're looking at a name like Amazon, where you're going to have sales numbers, you're going to have multiple earnings that apply, you're going to have seasonal issues that people are interested in, Prime Day, which just came. And, when you get those longer dated options, you're not going to typically see the vol crush because they encapsulate a number of events. So even though a little bit of event variance associated with each of those will get sucked out of those options as those events come and go, because there are so many, the real impact isn't going to be that great. So yeah, that's just a thought that I have for you on that. Okay. Oh, yeah, one other thing, you were just also talking about the charts. So, obviously, as you've seen, I do look at the charts. I mean, use your own judgment on that. Everybody has their own technical indicators. And of course, I take some guidance from people who are more of a specialist in that area than I am. And I will often use something that I've shown everybody who's watching now, which is I'll just take a look at some of the more popular technical indicators that people are using. Have they been effective of late or not? Sometimes I'll do this. I'll just sort and say, okay, which ones have worked out well? Moving average envelopes apparently has been working well for Amazon. That would be long here. K-bands, moving average oscillator. So it looks like it's kind of a mixed bag in terms of the technical indicators. RSI would still be short, but I will then sometimes say, okay, well, if that's the case, how close are we getting to a potential buy juncture? And as we can see on the relative strength, for example, it hasn't really been that great here because it actually, these types of technical indicators, it matters a lot where you set your buy and sell signals. And you can see here that this one just hasn't gotten down to that lower end of that range. But if we just moved this up a little bit, we can see that actually that might have been a decent indicator. We're getting closer to that lower bound, and again, we have this upcoming catalyst. So again, those are things that I think are worth thinking about. Okay, so couldn't agree more about IWM. Bought IWM puts at the close today. Yeah, I think if bad earnings or capex by mega caps could send the market down, no flight to the Russell or its proxies. You prefer bear put spread rather than puts. So I did, one of the reasons I liked it was because I thought that the payoff was still pretty good. What are the things that we want to think about when we're looking at put spreads? One is the payoff. If we did get a bump up in vol, that would be a reason why I might look to a spread rather than an outright. Because if some of that bump and implied volatility gets sucked out, then that's just going to give you more headwinds. If you're using a put spread, that mitigates that effect. So the chart that I'm showing right now, and let me get rid of the historical vol because we already looked at that. We saw the price action, so we know that the vol of the Russell has been higher. This is the price of 2-month options. 2-month options are what we're looking at. We're looking out to September. And we can see that sharp movement, as one might expect, also propelled the price of options over the course of the next couple of months. So the reason I'm looking at a put spread now is because of this big pop. If we look back 1 year, or actually this is 6 months, so let's go back a little bit further. Let's go back 2 years actually. Probably get a much bigger spread. So it puts it into some context. Was that ludicrously high implied volatility that we're where we are right now? No. But it certainly is at the upper end of the range of what we've seen, at least over the course of the last year or so. So I'm just going to draw a line from what the current implied volatility for 2-month options is. And I'm going to go back in time now to about a year ago. Here we go. Forgive me, it's not going to be perfect. So that's where we are. Do you want to buy that? Volatility is going to be driven by two things. There is a mean reverting element. It's obviously going to be propelled also by how much the underlying moves around. This is just it's more expensive, right? So now might be a time to think about using put spreads rather than outrights because you're paying up a little bit for these options. What's another thing we can take a look at? Well, skew is something else we can take a look at. Is there more skew? That is to say, are puts more expensive now relative to the at-the-money options? And some people will use moneyness. I think I would probably prefer to use either delta or sigma. Okay, so let's just go back. I'm actually going to go back 2 weeks ago. All right. So the white line here, this represents the price of options now on IWM versus where the price is for essentially the same tenor. That is the same amount of time to expiration and same deltas for these options just 2 weeks ago. Now remember, over this course of time, what we've actually seen is that the Russell has played material catch-up to the underlying index. what's the normal relationship between implied volatility and price that people expect? That is that they expect implied volatility and sometimes realized volatility to fall as the price rises. That isn't exactly what we've seen here. So we're in a higher implied volatility space, a reason to use a spread, and we aren't seeing this meaningfully flatten out, meaning that there's still a good bid. In fact, actually, if we take a look here, we can see that 15 delta puts, this lower chart, by the way, is just a difference chart. So what we can actually see is that implied volatility is higher. Skew, 35, 15 delta skew, so the relationship of the price of 15 delta puts to 35 delta puts has actually steepened. So that put that you're selling, all else equal, has actually gotten more expensive. So those are the two things that would encourage the use of a put spread. That's not to say that buying an outright like a 30 delta put 30 days out isn't a good idea. Just understand that as these dynamics revert, if they revert, that just becomes a headwind in your trade, right? So things to think about there. Okay. And there was a follow-up here. Also, if mega caps earnings are good, I could see many selling the Russell to pile back into mega caps. Yeah, look, it's interesting because part of this dynamic that we're seeing is that folks are saying, well, if we do get rate cuts, that's going to be a positive for small caps because they are more impacted. Okay, true enough. But my next question would be, if there are rate cuts, how are mega cap stocks likely to fare? Growth companies likely to fare in that environment. Probably going to be pretty good for them too. So, just something else to think about. Okay. And now I'm taking things out of order. Southpaw 96. Love the channel. Question I had, 150 puts for protection on my Tesla position. They expire on Friday. Due to the IT issues, I was unable to access my account to close them out by end of day. Due to the oh my goodness, what's going on here? My broker exercised the contracts. What gives? Also, I had to close my entire long position to cover the short and for a slight loss. Am I missing something basic? So Southpaw, could I ask the following question? These were puts that expired last Friday? I'm a little bit confused here. They should not, if you're talking about this coming Friday, that doesn't make any sense to me. Okay, so I've just got confirmation. So, yeah, so last Friday. Okay, so yeah, that does make sense. It's not your broker then that did it. So let's just take a quick peek. This is kind of an important point. Let's just understand what's going on here. So it was not your broker really that exercised those puts. It is a feature that the OCC, what most people refer to this as, is automatic exercise. That's not actually the technical language that the Options Clearing Corporation uses for this, but the idea is that if an option upon expiration is a penny or more in the money based on the closing price of the stock that day, that by default those options will be exercised. So if you find yourself in a situation where you can't get onto your computer because CrowdStrike does an update and all of a sudden you have an MS-based system and you can't get on there, and you know you own the 250 puts that expire at that day, and you also know that the stock is trading 245, and I'm assuming you wrote 150, but I'm assuming it was the 250s. Then what you actually need to do is you need to contact your broker and request a contrary exercise notice. You're going to file a contrary exercise notice, which means that, yes, I recognize that these are an automatic exercise. I don't want to. The other thing one could do is, of course, put in a phone order, a marketable limit order, something like that. Yeah, pretty unfortunate because, of course, the stock did, it did gap up today. But I want to offer you a different possibility, because if you are unable to do those things, so Friday comes and goes, and you are unable to close out your put position, you are unable to file your contrary exercise notice, so you now know that the stock is essentially going to be put, right? So your puts are exercised, so you're going to, offload your long position. You can cover that after hours. So if you had an opportunity, and we can see that the stock was trading below 240, you had an opportunity, presumably, to buy the stock 250 in the intervening period, right after the market closed. You could have put in a buy order, and that's actually what I would probably recommend. If something like this is going on, and then you have a little bit of an accounting nuance you have to deal with. What stock was actually delivered as a part of the exercise of those puts? You cannot trade options after hours, but you can trade stock. And frankly, I think in your situation, that might have been the call. That might have been the thing that you wanted to do. I realize, and look, it doesn't do you a whole lot of help now. This is behind us, but in the future, it's something for you and for everybody to think about. There will be circumstances, and actually this is one of the reasons why market makers always would hang out on Fridays anyway, because whenever we had a pin situation, so the stock is trading very close to strikes where we had positions, we had to kind of guess, are we going to be assigned on our short options? Are we going to exercise our long ones if they would otherwise not be? And what we would do is just pay attention to how the stock traded after hours and then respond accordingly. So that was something that I think is a good idea. Yeah, so Blackmud Video makes a suggestion. Always have a phone number for your broker in the event of technical difficulties with platforms or connectivity. That's a really good idea. And actually, I used to just have it, well, first of all, when we had the turret, so the turret is the trading system that traders typically have. If you look at a trading desk, you usually see this thing with a lot of buttons on it, a couple of handsets, sometimes a hoot speaker. And we just had a wire. So, our brokers, we could just connect directly to them. But it's really a good idea. Save your broker's customer support number into your phone, have it on speed dial or what have you, tape the number to your monitor. Just a good idea to have that handy. Okay, so sorry. Let's take. Let's see, mega caps, Google. Okay, what we got here? So PC says Google sold the August 175 put and have the Sept 185 200 call vertical net debit of $1. Thoughts on using options to execute a bullish trade? Number one, like it. Number two, call spread risky. That's what you've got. Kind of like that. Quick observation I would make. 175, the put you sold. 185, the call you bought. $10 apart. Not a huge spread on a stock like Alphabet that's nearly $200, right? So it's okay. I mean, you're at 5% or so, but generally speaking, so let's think about this for a second. So I often will say things like, I don't like to sell options going into events. Generally true. And then sometimes people will see me do things like call spread risk reversals and say, well, wait a minute, you're selling more options than you're buying. That's true. Isn't that kind of like a synthetically manipulated buy right or cash covered put position to do such a thing? And yes, you're sort of manipulating where you see this trade pay off. But what am I going to look at there? So what I will typically try to do if I'm going to do something like that is I will take a look at what the historical move for that stock has been and how I think about it going into this one. So we've got earnings coming right up. Today is the 22nd. I should know this. And so they're going to be reporting after the close tomorrow. So still time to act. The average earnings move is about 5%. The implied move is about 5.7. So if I'm going to try to give myself a range where I'm going to participate, the idea is that I'm going to try to get very close to at the money participation and potentially put the stock at some lower level. Here we can see all of the performance over the course of the last 8, 10, 20 reported quarters. If I manage to put a call spread risk reversal on that captures, call it 7.5% of the upside with a 7.5 buffer to the downside, that would mean that for this most recent reported quarter in April, I would have gotten about 3/4 of the upside that the stock actually delivered. Previous quarter would have been pretty much a push. We're thinking very short dated, right? Previous quarter would have been down 2%. Next quarter I would have gathered all of the potential money, push, would have lost about 2%, would have gained all of the upside. You see what's going on here? You get into a situation where you're trying to capture most of the potential upside move and trying to mitigate most of the potential downside move. So 175, 185, that 185 strike is a little bit higher up, and the 175 is a little bit higher up than I would like. I'd probably like to see those two strikes set down just a little bit, if possible, so that you're capturing more of the upside if it happens. Quick caveat to that. It depends when those options expire, because if I'm looking at earnings, but I carry an options position like that out, call it 2 months or 3 months, that position is actually going to behave a lot more like stock, or it's actually going to behave a lot more like a kind of like a covered call position in stock. That's what the delta is going to be like. The value of those spreads is not going to go right to intrinsic straight away. But if it's short dated, then you really need to think about levels. So that's really what you're doing. You're saying, okay, these are the kinds of moves we've seen. This is the levels that I'm actually targeting, and leave it at that. If it's longer dated, it's okay. It's going to behave more like stock. But then you're more in a covered call position, and in covered call position going into a catalyst, not my absolute favorite. So, yeah, things to think about there. Let's see, we've covered that. We covered that. Mega caps, good. Yes. Have the phone number. Thinking about buying more shares. And also I'm going to just double check my time. And of course we have chewed up the better part of an hour already. So let's just do a little bit of a recap here. Russell and the value trades have been outperforming, propelled, I think, by two drivers. One of those drivers is the likelihood of a Trump victory. The other is the likelihood of rate cuts. Higher likelihood of Trump victory, higher likelihood of rate cuts, better for value and the Russell 2000 relative to sort of the mega cap, which we can just use S&P or NASDAQ as our proxies for these. And then the opposite is also true. We have several weeks to sort of see how it shakes out in terms of the kind of support that Kamala Harris gets as the presumptive nominee. It is possible, I think increasingly unlikely, that somebody else comes into the story now. But with Clinton, with Pelosi, with Whitmer, because Whitmer was one of the candidates that had been floated as a potential replacement for Biden. I never really thought that was going to work because, number one, there's the campaign funds issue, which was problematic. Frankly, I think that it would be disastrous for for them, especially for Biden, not to endorse Kamala Harris, because how could you have chosen this person as your VP, the person who would succeed you in the event that something happened, and then say that's not the person to succeed me? There was no getting around this, as far as I can tell. Would she be the first choice of Schumer and Pelosi in a vacuum? I'm going to guess not, because she didn't poll well as a candidate for president when she was running for the Democratic nomination 4 years ago. She wasn't doing well. So with so many people polling better than she did then and polling better than she does now, people like Schumer and Pelosi, real political veterans, victory is what they want. And I don't think she would have been their first choice. But at this point, I don't really see how they can work their way out of it. Could be wrong. Maybe something happens at the convention, but I think it's unlikely at this point. So it's really her poll numbers that I think folks are going to have to focus on. Michael Anthony says, Harris couldn't control the border and she couldn't run the USA, and we need someone like Trump that would spend money on the armed forces. Well, I would argue that we're spending quite a lot of money on the armed forces already, and we are spending quite a lot of money on armed conflicts, more than I would like, more than we can afford. I think this is an important point as well. So yeah, with respect to immigration, Biden appointed her to oversee the border. And we'll just put some numbers to it. In the entirety of Trump's 4 years in office, I believe there was something like just about 2.1 million encounters at the border. And Biden's term is not completely over, right? So it's mostly over, but it's not completely over. There's another eighth of his term remaining. And that number is just shy of 7 million. So whatever you happen to think the cause is, the border crisis is significantly worse now than it was during the Trump administration. And Kamala Harris, number one, as part of the current administration, has to wear that failure. But more specifically, because she was appointed to deal with it, she bears a greater responsibility than she otherwise might have. Pence, for example, is probably not, having conversations, whatever conversations he is having, talking about border encounters, because he didn't wear that as a responsibility necessarily the way that Harris did in this administration. So it is a problem. We'll see. We'll see. And I'm not, look, I'm not trying to make this into I have my own views. I'm sure all of you do too. I'm not trying to turn this into a political conversation. What I am interested in, though, is the impact that these things can have for the stuff that you guys are tuning in to talk about, which is financial markets and the economy, and more the former than the latter. And the fact of the matter is that we can see the correlation in real time of investors in equity markets and their view of who is the better candidate for certain groups of stocks, like small caps. This is indisputable. We can certainly have debates about these other issues. Would certainly like to have debates about those other issues, but I'm not going to torture people with that right now. So, anyway, yeah, Easy Mike follows up with, how's that wall building Donnie did? So, this is an interesting conversation because the Biden administration argued somewhat vociferously against the efficacy of barriers at the border, specifically when they got into a legal dispute about taking down some that for example, in Texas, they were putting some up in certain areas, and as this became more of a political liability for them, having won their legal case, decided not to tear down the things that they had actually sued to tear down, which is a rather interesting response. If you are going to engage in a legal debate, a legal dispute in order to do something, and then you win that and don't actually act because you recognize that immigration is a little bit of a political hot potato, I think we can certainly say that it's not something that they want to run on, the Democrats, right now. I think actions speak louder than words, and we're seeing their actions, or in this particular case, a lack of action. And that lack of action tells you all you need to know about what they think. And of course, there were plenty of disputes about putting up the wall in the first place. But the fact is that at the very least, it slows people down, doesn't it? One could use a wall to at least get people to go through appropriate checkpoints. We have a big southern border. I lived in Texas. There are vast reaches of Texas that a wall is not possible. It is not practical. Just, I don't know that it's realistic. But the fact is that we have policies now that have changed the flow of immigration over the southern border. And so whatever you think the appropriate technique is to either increase or decrease immigration, as is your want, we have to acknowledge that different political parties encourage or discourage it. Make your own mind up about whether you think that's important. As far as I'm concerned, I would like to encourage immigration, but the immigration I would like to encourage specifically, and where I think we are overly restricted, is in the H-1B space. We need skilled labor. We have a lot of people that want to come here. The H-1B process is difficult. It is overly constrained, and we need to address that. And I'd kind of like to see us focus on that. And finally, Michael Anthony says, shocked that the market went up today after Friday's event around the world with all airports closed for almost 2 days, which AI didn't help. And then Biden has COVID and all the rest of it. So, yeah, this is kind of an interesting thing. I was thinking about that too. The CrowdStrike issue essentially made everybody aware of a very large vulnerability that they might not have. By the way, we talked about this on Fast Money on Friday. So there was a lot of bearish activity in CrowdStrike. It traded something like 22 times its average daily put volume last Friday. It was trading the volumes on the option side that companies, much larger were doing. It was in the neighborhood of NVIDIA and Tesla and Apple. That was the kind of volumes on a notional basis that we were seeing in CrowdStrike. And there was some expectation of follow through. The August 250 puts was the second busiest contract, if I remember correctly, and this week's 300 puts were the most active contract as of last Friday. People expecting some follow through. What we found is that we have a vulnerability that I think was not on a lot of people's radar. And it's ironic, of course, because CrowdStrike is, from a security standpoint in the cloud, considered to be, creme de la creme, right? So when you think about that, that suddenly you would have a vulnerability like this, caught a lot of people out. And also, just in terms of infrastructure, did two things. So number one, we became aware of how much CrowdStrike could impact all of these different areas. The other thing that's a little bit more concerning in some ways is it helps, malfeasant actors potentially identify points of vulnerability, saying, "Aha, well, we have an issue here." So that's the negative way to look at it. The positive way to look at it is that my guess is that CrowdStrike isn't going to make this kind of a deployment mistake again. I wish we weren't quite so, in such a situation where you pull one pin out and 60% of the system suddenly falls on its ass. That's a real problem from my point of view. But I'm hopeful that CrowdStrike in particular, and the CEO owned this problem. Luckily, it was not a cybersecurity breach. Had that been the case, wow, that would have been an even bigger problem. But it is interesting that that vulnerability isn't really impacting things. But maybe it's because people believe that now that that weakness has been identified, that it isn't as much of a weakness, or it will not be as much of a weakness in the future. And so I guess we will end it there. For all of you guys who tuned in to watch today and chewed up an hour of your day to listen to me ramble on, I really appreciate it. Thank you very much. If you're not subscribed, think about it. Try to encourage some of your friends to tune in, and I will see you in the next one, which I'm going to do on Wednesday at 4:15 Eastern Time. Thanks for watching.